one of the most challenging parts for founders is when you're going through the capital raising process and you're struggling to get investors across the line and you're wondering, what is it that I'm doing wrong? So here's 9 areas that you can look at to adjust your capital raising to help in the process and help take investors that are potentially not investing and have them become shareholders. Okay, so let's go through it. So the 9 key areas. Now in this video, I said we're going to cover a couple things. So get ready. We're going to put them up on the screen and get ready to take notes. So firstly, timing. Now timing is everything when it comes to a capital raise. I've seen it where certain sectors, when they're in favor, becomes super easy for founders to be able to raise money. When those sectors become out of favor, it's amazing the difference and amazing the effort that companies will have to go through the capital raising process. One of the best examples we've seen of that in the recent Australian market has been anything to do with the buy now, pay later area, right? These companies have found it incredibly easy to raise money. When they go on list, they've had an incredible response on the share price, etc. Right, so that's been an example of a sector that's been in favor. I've also seen it where sectors where, it could be 1 year's difference and sometimes even 6 months. And it's massively easy for them to actually raise capital 6 months prior than what it is today. And it's really just to do with sector momentum. And just for the own sort of mental note, a rising tide lifts all boats. And typically investors have that in their mindset when they're looking at potential offerings. Second one is valuation. Now, this is probably one of the trickier areas of dealing with founders is often they don't really understand. They don't understand how this plays a role in their actual capital raising. And sometimes when investors disagree with their valuation on a company, sometimes rather than actually talking to you about it, often they'll go quiet. Whereas a portion of investors will actually mention, look, that's out of my price range, or I think the valuation is too high for where you're at, etc. Very, very common story. So for most companies, what we do is we try and highlight, if you're going to place in placing a valuation of your company, you've got to do one of 2 things. You've got to give a reference for that valuation. So examples of other companies that are similar to yours that have actually raised capital at that valuation, or, give some guidance as to how you actually come up with that valuation for the actual business and why you're positioning it at that valuation. Right, the reason is it makes a difference for the investors and means they don't have to keep on asking the question. And for you, most importantly, it means you don't have to answer that question over and over again. Presentation is another one. Right, so number 3, I'm going to put down as presentation. Sometimes presentations from founders just isn't up to scratch as far as what investors are expecting, or sometimes it's too long, it's too complicated, it's too technical. Right, there's all sorts of different factors that go into why a presentation can be challenging. I looked at one recently where I could barely actually read the text. In fact, it was so difficult for me to read, right, I didn't even bother actually going through the entire presentation. Now, the hard part for me is, as a founder myself, I like to give respect to other founders and the work they're putting in that time. Right, but I just mentally couldn't go through this presentation because it was just so difficult for me to actually read the text on the actual screen. It was too small, it was all bolded, they were all together, it was blurred between sentences. It was just that difficult to read, right? So sometimes the presentation is an issue, right? So we've covered 3 areas now. First one, timing. Second one, valuation. Third one is the actual presentation. Now, the next one, 4, is the frequently asked questions. Now, I'll highlight this because basically in getting the frequently asked questions right, we've highlighted to companies that the key areas they need to focus on is obviously how they're actually going to be producing revenue growth for the business, right? Number 2 is what is the potential exit timelines? And number 3, is there any other strategic relevance that potential investors could add as far as from a value perspective to the actual business? So typically I like to highlight those in the actual frequently asked questions. It has helped, just really simplifies that process of naturally what investors are already thinking. Okay, number 5, you need to look at your process. So if you're challenging with raising money, let's say there's a lot of people are looking at your opportunity, you've had 20 to 40 investors already go through and none of them actually participated, then maybe your process is not right. Maybe your email is too lengthy. For example, we're working with one company and they, as a first email to investors, they will send a 5-page email with 5 documents attached. Now, to me, that is absolutely insane to send that as a first point of contact. We had another company we're working with one time. They were sending through an 80-page document as a first step to potential investors, right? This is before they'd even expressed interest or anything. This was their first step. So sometimes the process may be inefficient. Now, of course, we've done lots of videos talking about how to improve that efficiency in the process. But really, as we always highlight, the more efficient you can make the process from the investor side, the easier it is for them to engage with your opportunity. So consistent refining of your own process is really important, with templates, with scripts, with etc. And really, it's not about trying to be a master, a master capital raiser. It's just trying to make it easier for the investor. 6 could be board and management. This can be a tricky one for companies. Effectively, when most investors are looking at companies, they're trying to understand, does the board and management have that been there, done that experience, right? And having that sort of experience is what helps them get confidence that you've got the ability to execute on your plans and basically doing what you say you're going to do. So it's a really one of those sort of points where it's a tricky point where you have to look at your own board and management and ask, if you're external, if you're looking at your company with fresh eyes, is this the team that can help you execute on your own plan? Are they the ones to help you navigate the troubled waters if they come across? Are they ones to help navigate the excitement and the scaling of growth phase? They're key points that you need to ask when you're looking at your own board and management. Right, so the next ones really relate to that sort of, so that's number 6, and then number 7, look at the percentage being offered, right? So number 7 could be, if you're looking for strategic investors, often strategic investors have a certain percentage amount that they're looking to invest. So what I've found for myself in dealing with private investors, they typically have an amount that they're looking to invest. When dealing with more strategic investors or corporate investors or venture investors, typically it relates to percentage, right? So understand that. The bigger the investor they are, the more they're focused on the percentage side. And the other part is the more private they are, the more they focus on an amount, right? So you may need to look at the percentage being offered in that round, right? Is it enough? Is it too much? Is it too little, etc.? And that will sort of help you guide, so for some investors, their minimum amount that they're looking to pick up is they're looking to pick up between sort of 15 to 20% of the company if they're going in very early, right? Others have different criteria. But once again, it's just trying to understand the different investor that you're dealing with, and does the percentage amount being offered actually make sense, along with the use of funds going with that. Okay, the next one is your communications. So as we're always highlighting for companies, and this is number 8, so 8 for communications is when you're actually going through this process, there's lots of different touch points, whether it be emails, whether it be webinars, whether it be phone conversations, etc., or whether it be just the communication via your actual deal room. So once again, the job from the founder is to make it as efficient as possible and to provide as much relevant content that's of interest to potential investors coming into your business. Right. And what I've always found, and this is a simple thing that I learned from marketing, is when people are interested, they will spend a significant amount of time looking at your information, right? Because it's of interest to them. Right. Now, of course, to get people interested, you need to make it simplified, efficient to get that interest part. But once they're interested, they may want to spend more time. And this is why providing all different touch points of content is really important. But you still need to simplify and still need to be clearly articulate what the plans are for the business in those communications. And then the last one, number 9, is just your simple investor targeting. Understanding that if you're a highly technical business, maybe it could be difficult for you to go down the equity crowdfunding path, as an example. But if you're a B2C type business and have a strong retail following, then that could be an ideal model for you. If you're looking to target investors that potentially could add strategic value, then it could be either through high net worth investors, corporate investors, or even family offices, right? So it just really depends on your actual strategy, but investor targeting is always an important point, right? And if you're looking to get people specifically from your industry, then you need to build your profile in your industry, right? So that really sums up the 9 key areas that you can look at if you're not currently raising capital. Now, each one of those can obviously be broken down and spend a lot more time on, but I just wanted to provide that at a high level. So just to go through them once again, the 9 key areas are, number 1 is timing. Number 2 is your valuation you need to have a look at. Number 3 is your actual presentation itself, your pitch deck. Number 4, your frequently asked questions. Number 5, the actual process that you're working with investors for the actual capital raising. Number 6 is board and management. Number 7, the percentage being offered to investors coming in. Number 8 is your actual communications to investors. And number 9, your investor targeting. I hope you found that helpful. As I said, I understand it's one of the most frustrating things for founders when you're not able to raise capital. Often you don't know what levers to turn to help make that sort of either turn on that potential for the capital, or to make those adjustments necessary to attract the right investors to your business. Thank you very much, and I hope you enjoy more content from us shortly.